I want you to picture two brokerage screens. Same year, same starting capital. The first screen belongs to an investor earning $250,000 per year. Log in and you'll find a chaotic dashboard. There are 42 individual tech stocks, 3 different AI-managed private equity funds, a fractional slice of a digital real estate plot in a metaverse that peaked in 2024, and 6 different crypto wallets with recovery phrases scattered in various desk drawers. This person spends 4 hours every Sunday rebalancing and reading Discord alpha leaks. They check their portfolio with a knot in their stomach every time the NASDAQ dips 1%. Despite the high income, they are one market correction away from a liquidity crisis because their wealth is locked in illiquid, high-fee traps. The second screen belongs to someone earning $72,000 per year. Log in and you'll notice almost nothing. A single total world stock index fund, maybe a treasury bond ETF. That's it. This person spends 4 minutes a month on their finances, just enough time to ensure the automated transfer cleared. They check their accounts with calm confidence. They have 5 years of freedom runway, and their simple portfolio has outperformed the first person's complex mess by 4% annually for a decade. The person earning a third as much has nearly 5 times the actual usable wealth. This isn't a story about stock picking, it's a story about aerodynamics. In 2026, the greatest threat to your wealth isn't the market, it's engine drag. Most investors are trying to win a race while towing a trailer full of high-fee, exclusive funds and heavy, complex strategies. Today, I'm walking you through the minimalist investing rules that turn your portfolio into a stripped-down F1 car. As Nassim Taleb says, we grow through Via Negativa, the art of improvement by subtraction. Rule number 1. Calculate the complexity tax. Everything you own in your portfolio costs you money twice. The first cost is the expense ratio, or the spread. The second cost, the one that kills you, is the cognitive load. Every individual ticker you own is a mental tenant living in your brain rent-free. If you own 50 stocks, you have 50 CEOs, 50 earnings calls, and 50 potential scandals to worry about. In the urban sprawl of 2026, your mental bandwidth is the most expensive real estate you own. Research shows that investor friction, the act of checking, tweaking, and worrying, is the primary reason retail investors underperform the boring index by 3% or more. You aren't just paying a management fee, you are paying a stress tax that degrades your ability to perform at your actual job. Minimalists calculate the total cost of ownership. If an investment requires a Discord subscription, a specialized tax form like a K-1 or daily monitoring, the engine drag is too high. Cut it. Rule number 2, the signal-to-noise filter. In a world of 24/7 AI-generated financial news, information is the new status trap. People think that by consuming more data, they are gaining an edge. In reality, they are just increasing their noise floor. Naval Ravikant famously noted that an empty calendar and an empty inbox are the ultimate status symbols. Apply this to your investing. If your strategy requires you to know what the Fed chair said this morning, your strategy is fragile. Minimalist investing is built on invariance, things that stay true regardless of the news cycle. The world will continue to produce goods and services. Companies will continue to seek profit. If you bet on those two things via a broad index, the noise becomes irrelevant. Rule number 3, apply the asset replacement test. Once a quarter, look at every asset you own, every stock, every alternative fund, every sneaker collection investment. Ask yourself, if I woke up today with 100% cash and no positions, would I spend today's money to buy this back at its current price? Be ruthless. Would you actually go out and buy that carbon credit offset fund again? Would you rebuy that speculative biotech stock that's down 40%? Most people hold on to losers because of the sunk cost fallacy. They feel they need to get back to even. Minimalists realize that the money is already gone. All you have is the current value. If you wouldn't buy it today, sell it today. This creates portfolio space. It turns your brokerage account into a crowded junk drawer, into a streamlined vault. Rule number 4, kill the upgrade impulse. The most common 2026 investors destroy wealth is by upgrading their strategy. They start with a solid boglehead approach. Then they hear about a new generation AI alpha fund or a tax loss harvesting overlay that promises an extra 0.5% return. These upgrades are wealth destruction disguised as progress. Every time you switch strategies, you incur slippage, taxes, and most importantly, you reset your compounding clock. As Alex Hormozi puts it, the boring work is usually the work that pays. The impulse to find a better way is often just boredom in a suit. An investment remains functional until it fails to capture the market's return. Boredom is not failure. Rule number 5. Engineering friction and ease. Human willpower is a finite resource. If you have your trading app on your phone's home screen, you will eventually trade out of fear or excitement. Minimalists design for automated friction. Delete the apps. If you want to trade, make yourself log in via a desktop browser with two-factor authentication. The 72-hour trade rule. Never execute a sell order the same day you thought of it. Wait 3 days. 90% of the urge to panic sell evaporates within 72 hours. Invisible buying. Set your contributions to happen before the money hits your checking account. If you never see the raw income, you never feel the pain of saving. Rule number 6. Beware the lifestyle multiplier in assets. We often think of alternative investments as a way to diversify. In reality, they are often chore multipliers. Buying a rental property isn't just an investment, it's a part-time job involving plumbers, property taxes, and tenant disputes. Buying fractional art requires monitoring a specific marketplace and understanding a niche legal framework. Minimalists prefer liquid optionality. A liquid index fund has a lifestyle multiplier of 0. It requires no maintenance, no storage, and no phone calls at 2 a.m. And rule number 7, define your freedom finish line. High earners stay poor because they never define enough. They earn $500K, so they think they need a $5 million portfolio to retire. Then they earn $1 million, and suddenly they need $15 million because their tastes have upgraded to private jets and Hamptons rentals. Minimalists set a static target. They decide, I need $60,000 a year to live a magnificent, deliberate life. At a 4% withdrawal rate, that's $1.5 million. Once they hit that number, every extra dollar isn't for more stuff, it's for optionality. True wealth is measured by the ability to say no. No to a toxic boss. No to a 60-hour work week. No to social obligations that drain you. The person with 42 stocks and a digital real estate portfolio is a slave to their complexity. They can't walk away because they don't even know what their exit looks like. The minimalist with 2 index funds knows exactly where the finish line is. They reach it faster because they aren't carrying the weight of 1,000 unnecessary decisions. Now, here is your 2026 implementation plan. This week, perform the replacement test. Look at your holdings. If you have more than 5 individual stocks or alternative funds, ask if you'd buy them today. If not, liquidate and move to a broad index. This month, increase your automated friction. Remove the Face ID login from your brokerage app. Make it hard to be impulsive. This quarter, define your enough. What is the annual cost of your ideal deliberate life? Multiply it by 25. That is your number. Write it down. When you stop trying to beat the market and start trying to be the market, you stop being a gambler and start being an owner. The math is clear. The less you do, the more you make.